Okay, let's dive into this. Today, we're looking at one of the absolute most fascinating wealth-building stories in modern history. We're talking about a man who built a reported net worth of over $100 billion. And get this, he didn't do it by inventing some groundbreaking new technology, and he didn't inherit a massive family fortune either. He did it simply by winning, consistently, in the stock market. So how did the Oracle of Omaha actually pull this off, where so many millions of others have failed? Well, we're going to unpack exactly how he did it.
Now, there is a bedrock philosophy behind everything we're about to unpack today, and it goes like this. The first rule of investment is don't lose, and the second rule of investment is don't forget the first rule. I know, it sounds almost too simple, right? But this incredibly disciplined, totally risk-averse philosophy is the absolute core of his strategy. The idea is if you buy things for far below what they're actually worth, you basically don't lose money.
So the real question we have to ask ourselves today is this. How did a shy, quiet boy from Nebraska, who started out literally selling bottles of Coca-Cola door to door, transform into the architect of a $100 billion empire? Well, to understand the investor, we have to understand the journey. This explainer is going to walk you through the pivotal life stages and the specific strategy shifts that shaped his ultimate investing masterclass.
Section 1. The Boy from Omaha. Born in August of 1930, literally just a year after the Great Depression devastated the country, a young Warren Buffett learned the absolute, undeniable value of money early on by watching people around him severely struggle to make a living. Spending time alone reading books in his father's library, his early obsession with compounding took hold fast. At just 6 years old, he asked his grandfather for drinks to sell around the neighborhood, making a 5-cent profit on every single six-pack of Coca-Cola. By 14, he was working dual newspaper delivery routes, making $179 a month, which, to put into perspective, is over $3,000 in today's money. He even bought pinball machines with a friend, split the profits with barbershop owners, and by age 15, he used his savings to buy a 40-acre farm in Nebraska. And this brilliantly illustrates how his obsession with compounding business started remarkably early. His drive was simply relentless. But it was actually at age 11 that he learned his most painful and definitely his most valuable early lesson. He took his hard-earned savings and bought 3 shares of an oil and gas company called City Service at $38.25 a share. Almost immediately, the price tanked $27. He panicked, held on tight, and the very second it recovered to $40, he sold it for a tiny, tiny profit. But then he watched in absolute horror as those exact same shares shot up to over $200. It stung, for sure, but it taught him a massive lesson. Selling too early was a mistake, and his real game wasn't day trading. His real game was owning good companies for long periods of time.
Section 2. Meeting the mentor. So after high school, Buffett actually used his farm income to pay for college. But get this, he was completely rejected when he applied for a master's degree at Harvard. Crazy, right? Well, that rejection turned out to be a massive blessing in disguise, leading him to enroll at Columbia Business School instead, where he'd meet the great economist and investor Benjamin Graham. But before diving into Graham's teachings, Buffett had a major hurdle to overcome: public speaking. He was so introverted, he would literally sometimes throw up out of pure nervousness. But he absolutely knew, he couldn't be a business tycoon if he couldn't speak to people. So he made the crucial decision to take a public speaking course, proving his belief that investing in yourself is the absolute greatest investment you can make. That single course completely transformed his ability to confidently project his brilliant financial ideas. Armed with this new confidence, Buffett went to work for his mentor, Benjamin Graham, in New York. Graham taught him the art of security analysis, basically determining the true underlying value of a company purely based on their raw financial numbers and balance sheets. But, Buffett's inquisitive young mind soon started to branch out. While Graham really only cared about the strict numbers, Buffett started to question whether a company's human management was just as critical to the investment decision as those raw numbers were. Section 3. The Cigar Butt Strategy. By 1956, Graham retired, and a 25-year-old Warren Buffett returned to Omaha. He decided to start his own partnership right out of the bedroom in his house, with $105,000 pooled from his friends and family. Now, what's really interesting about this slide is how he took his mentor's philosophy and pushed it to the absolute extreme with what he called cigar butt investing. Imagine walking down the street and finding a disgusting, disgusting cigar butt. I know it's gross, but there is exactly one free, profitable puff left in it before you throw it away. Buffett applied this exact logic to the stock market. He hunted for terribly performing, completely failing companies that were so absurdly cheap that even if they went bankrupt, their raw liquidation value guaranteed him a profit. And let me tell you, this strategy worked flawlessly. From 1956 to 1969, this young, teenage-looking kid from Omaha, operating out of a bedroom, generated a jaw-dropping 29.5% compound annual return. He literally outperformed the entire stock market by a factor of 4, all by himself. He grew that initial $105,000 venture into a $7.2 million foundation in just 6 years, and eventually managed over $100 million in assets.
But then, he did something completely shocking. By the end of 1969, at just 39 years old, Buffett dissolved the entire incredibly successful partnership. Why? Well, it goes back to his famous mantra: be fearful when others are greedy, and greedy when others are fearful. The market at the time was booming. Stock prices were soaring. Everyone was getting greedy. And Buffett knew it was an overvalued bull market that was about to end. It was getting way too risky to find those cheap cigar butts, and he absolutely refused to risk his clients' money. So he gave it all back.
Section 4. The Berkshire Hathaway Pivot.
So with $25 million of his own personal wealth secured, the story gets really wild. It all starts with Buffett buying shares in a failing textile mill called Berkshire Hathaway as a classic cigar butt investment, picking them up for just $7.50 each. The owner of the mill later agreed to buy them back from Buffett for $11.50. But when the official written offer arrived, the owner tried to cheat him out of exactly 13 cents a share, offering $11.37 instead. Well, Buffett was infuriated. In a move of pure spite, instead of selling, he bought out the entire company just so he could fire that owner. He got his revenge, sure, but now he was stuck holding a completely declining textile business, which forced him to rethink his entire cigar butt approach. Being stuck with that failing business forced a massive revelation. Luckily, his business partner, Charlie Munger, helped him see the light, triggering a complete shift in his philosophy. So, the crucial point is that they moved from strategy A, buying fair or even terrible companies at great, cheap prices, to strategy B, buying great, high-quality companies at fair prices. He phased Berkshire out of textiles entirely and turned it into a holding firm specifically for this new strategy. To find these great companies, Buffett started hunting for something he called an economic moat. Think of it like a medieval castle. The wider the moat, the safer the castle, right? In business, a moat is a company's ability to maintain a massive competitive advantage and protect its long-term market share from rivals. He started looking for impenetrable brands. For example, Coca-Cola. It's been around for a century, connected with billions of people. That brand recognition is an incredible, untouchable moat that makes it nearly impossible for anyone else to really compete. Section 5. Moats and insurance float. Now, to actually buy huge shares in companies with massive moats, like American Express and the Washington Post, you need a lot of cash. Starting in 1967, Buffett realized that insurance companies operate a whole lot like banks. First, you collect regular premium payments from insurance customers. Second, the insurance company sits on massive piles of this cash, which is known as float, waiting to pay out future claims. Third, Buffett realized he could use this idle float cash to carefully invest in those exact grade A, moat-protected businesses we just talked about. By buying insurance companies like National Indemnity and Geico, he tapped into billions of dollars of virtually free cash to supercharge his investments. It was a brilliant financial engine. Let's move to and see how this builds to one of the most incredible, poetic, full-circle moments in business history. Using this massive insurance float, he started buying up shares in the ultimate moat business. The exact same boy who went door to door at age 6, selling 6-packs for a tiny 5-cent profit, grew up to acquire 7% of the entire Coca-Cola company's total stock. This was the ultimate result of his long-term consistency. His holding company, Berkshire Hathaway, just skyrocketed, with its stock eventually trading in the hundreds of thousands of dollars per share. And through it all, Berkshire Hathaway became one of the most powerful companies in the world, holding major shares in absolute giants like Goldman Sachs and Bank of America. Buffett's net worth peaked at over $100 billion, making him, at one point, literally the richest man on earth. Yet, despite this mind-boggling success, he remained astonishingly frugal. He still drives a 2014 Cadillac, and he often grabs a simple McDonald's breakfast on his way to work. He is a man of unwavering personal principles, high integrity, and extreme discipline. He started by picking up discarded corporate cigars for a quick, cheap puff, but he became a billionaire by building an impenetrable fortress of high-quality assets. So, as we wrap up today's explainer, I really want to leave you with a question, something to challenge you and apply to your own financial life.
Are you trying to build a long-term moat around your wealth, or are you just chasing after discarded cigars? Think about it. Thanks for joining us, and we'll see you next time.